Hi, in this video I'm going to be discussing trading the non-farm payrolls. There's a lot of excitement about trading non-farm payrolls. You hear and you see many videos on the subject, and I just thought I'd throw my own two pennyworth in because it is such an important number. We should obviously pay some respect to it. So, trading it, the non-farm payrolls. Firstly, we should understand what it is. It's one of the key news events that's released, this one every single month. It can determine at times interest rate increases, reductions, etc. So it can certainly have a heavy bearing on those. So it's seen as one of the key numbers that come out every single month. Now it's released on the first Friday of each month, and it contains such content as the average earnings, the employment change month on month, and the unemployment rate. So these three numbers. Now, depending on where we are in cycles, etc., there's a different bearing in terms of the focus. Each month, the Fed, each month, every 6 weeks, or whenever they're meeting, the Fed actually give some sort of idea of what they're looking for before they change things. In terms of increasing interest rates, in the first place, they were really looking at the average earnings starting to increase. The employment change, of course, particularly as we went through the COVID stages, it became a bit massively unhinged. That it really didn't make a lot of difference on some of those figures. It was shocking, of course, but it varied, and even when we saw the big numbers coming back into being, it didn't necessarily make major steps at times. As I said, the decision makers were really looking at average earnings, and of course the unemployment rate itself. This is the core rate in terms of how the percentage of the working public are actually unemployed. Now, all of the figures to me are manipulated in one form or another, and I'm sure we can have our own thoughts on that. However, it matters little in terms of the outcome. The information is released on the first Friday of each month, so that's generally the first Friday of each month. On occasion you'll find that it will be released on the second Friday if there's been a bank holiday, but generally first Friday of each month. And it follows, I should say, the ADP data. Now the ADP data has only just been reviewed. It's the ADP normally comes out 1 or 2 days before, normally on the Wednesday, and we get the non-farms on the Friday. That's the most common way. Sometimes one gets shifted slightly because of holidays, but either way, the ADP non-farm payrolls, which comes out 2 days earlier, can be as useful as a chocolate teapot. Generally its hit rate has been awful. However, it's been missed a month, and they've increase the sample size, etc. So it'll be interesting to see how close the two come. Why the need for two? I don't know, but anyway, it'll be the earlier one. At times it does create volatility, the ADP non-farms, but the price or the market soon forget it and look at it as being, well, just a blip, but generally it's, as I said, not particularly useful. So it is the key non-farm payrolls that you should be looking at. Now there are clashes in non-farm payrolls, I should add as well, as we come on to sort of next slide here, and looking at what currencies you should trade, because the Canadians, they put their number out often on the same day. It's mostly on the same day, not always, but mostly on the same first Friday. So if you were trading the Canadian US dollar, you got potentially a massive double whammy. If the Canadian goes one way, the US dollar goes another way, well, perhaps you could get some super duper moves, but it's something you should bear in mind. The other thing you should bear in mind, particularly if you're looking at from an intraday point of view, is the liquidity of what you're trading. Some of the markets, let's say in the New Zealand dollar, you might see some really big moves, but getting in and out of the positions is pretty difficult at times. You might find yourself with the liquidity missing, and yourself getting requoted or just massive slippage, and that's really what you don't want around this news, is massive slippage. So the real big hitters, of course, is the euro and the yen. They're the top two traded currencies for non-farm payrolls. Some people lean towards the yen because of the greater movement at times, but personally I look at, well, where's the moves happening, looking really for the strength or weakness of the pair against it, and this is a standard rule of thumb, even if you're trading it over the longer time, is looking at the stronger or weaker pairs and seeing which pairs are working the best to take advantage if there was weak non-farm payrolls, or take advantage if there's particularly strong, which are the weaker currencies that might move the best. So it's important you run through this. As I said, generally I'm looking at the euro or the yen. Next thing to look at is the timing. Do you trade them pre-news, immediately on the announcement, shortly after the news, next day, or my preference, when the technicals align? So this, when the technicals align, doesn't mean to say I'll day trade it. I used to day trade. So if we go back for a moment and look at these and start again, pre-news, basically you're taking a guess at what might happen. You might already have you might have a view of what might come out. Beware with this news. Often you can see quite large spikes in one direction prior to the news, or just as the news is hit, and then it goes completely the opposite. It's one of those that can move the markets quite quickly, and that movement can be brought about by bigger traders having to play with the market, but the lack of bigger traders often in the market, and it's left to the more retail traders to be fighting over these moves. I'm not saying bigger traders don't trade it, but they're less likely to. Pre-news, yes, they'll have their opinions, and perhaps some of the big money will be in it weeks and months beforehand, not within an hour or so. You've got to look at the positioning. Of course, 5 minutes before or something like this, huge risk, because you're going to be entering where price starts, where near enough where price is, and of course the risk is much stronger. If you're already in the money on a position because you've taken a position days or weeks beforehand, or even earlier in the day, if it's well into the money in terms of you're profitable on the trade, perhaps you could hold. Immediately on the announcement, well, to be fair, I've in the past traded this immediately on the announcement. I've sat there, I've had orders placed either side of the price action. It again has massive risk in these days. With the volatility, often it's being struggled for brokers to fill positions at times. You can find yourself slipped massively, or well, that's generally the worst thing that happens, is you'll get slipped massively. So it's really the next to pre-news and just before the news, it's certainly a very risky place to be. Shortly after the news, now we get loads of different options of what to do here, and I'm talking about trading it, so I'll give you some sort of views in terms of what traders would do. They'll see the news, they'll wait for a retracement, and then they'll trade the original direction. See what it is yet? So it may be a little ABC movement. So they're waiting for this retracement, and off it goes. It's a way of trading it. You can do it in various different ways. If it's come down to some key support, that may be fine. You could be looking at the break of the previous high. Again, could be fine. Still very, very risky, and I see a lot of traders get caught out on this, particularly as it goes in maybe to the double top. Well, if you're taking part exit at double top, maybe that's well, certainly got less risk about it. If you're expecting it to move a long way, again, it really depends on the numbers. If you're sitting there looking at the numbers and say, well, actually this is a game changer, yep, sure, it could be a small retracement as a bit of profit taking that occurs, and off it goes. So this is one method. Other methods may include, I haven't drawn this too well, but you've had the big starting candle here, and then if maybe on a 5 or 15 minute chart you're getting like an inside bar. Traders would take the which way the market runs out of this. If it runs to the low, breaks the low first, they'll take the lows. If it breaks the highs first, they'll take the highs. Again, it's a similar principle to here in terms you're letting the consolidation occur, something occur there, and then trading either. Again, both of them are extremely risky. If you're short-term trading these, if you're trading them on a bigger picture, they've probably got a lot less risk there, and you're taking what at the end of the day is going aligned with the technicals themselves. But short term, these are a couple of the ways that I've done. I mentioned immediately on the announcement where that is simply looking at wherever the price is and having a buy stop or a sell stop either side with orders either side of those. It worked for quite a few years when brokers were a little bit happier letting the news rush over them. There was plenty of money being given away, so they were happy to fill these and give you the profits. However, it's a bit of a minefield, and I wouldn't necessarily recommend it. So these are some ways of trading it. Let's clear those. Shortly after, next day, letting things settle down. When I say next day, of course it's a Friday, and I've realised that I did this on purpose. Not next day, next trading day. So on the Monday afterwards, follow through. One thing to bear in mind on that day is often after Lord Mayor's show comes the cart. It can be a rubbish day, the Monday. You can see, but if something major has changed, then if it's a big shift and it's more likely to result in a change of Fed policy, then you've got something changing. But then only then do you trade it when the technicals align. And this is my preference these days. So tomorrow when the non-farms come out, I'll be sitting on my hands mostly. There are opportunities to scalp, I should mention as well, in all of this, but generally most traders will get caught and scalping and end up giving more back than they make. Sometimes they do okay, but there's risk with it. We all there's plenty of opportunities and different methods out there. How frequently they actually work, well, they are pretty random at the end of the day. So when the technicals align, what I'm going to show you now is we're just going to run through some numbers, and we'll just run through. This is from the 1st of April, so we're just going to show. This is an hourly chart. In fact, we can come. I've also got it marked on a daily chart. Hopefully it's the 4th of April. Have I got the wrong day there? Let's just check. Oops, wrong one. Let's come back here. Yeah, it's the 1st of the 4th. Let's just check that was the right date. That is the right date. I've got the wrong date sitting on the daily, I believe. That's the 4th of the 4th, 29th, 31st, 1st of the 4th. There we are. It's actually I've got it showing on the wrong bar there. Expectation. There we go. These greens and reds, these are just the dates that the data has come out. It's not there's a buy signal or sell signal. It's just in terms of putting them either side or around the price action, so they mean nothing aside of that was the day it came out, 1st of the 4th. That's when the news came out. Here's what happened basically on an hourly picture. Okay, you'll be down probably on a 5 or 15 minute chart if you're looking to day trade these, but you can see very little happened, and we've seen this a lot at different periods where the earnings and the non-farm payrolls didn't do a thing. We saw 15-20 pip moves overall. In fact, on the hour that this came out, that 1 o'clock bar, which bearing in mind it comes out 1:30, but I should have mentioned that, the hour there, it moved the whole trading range. That was 23 pips, and then we had the inside bar afterwards. But what we can see is a trend. It may be that you're waiting to trade this, looking at it on the Monday, seeing what's coming down. If things, well, what happened? Earnings were in line. Change of employment, 431,000 more jobs versus 492, so it came in a bit short. But on the other hand, the employment rate dropped 3.6 versus 3.7. So it was a bit of a mixed bag. That's why it just didn't really do too much, and off it went. As we go to then, let's go to the next one. I'm going to just do a little cheat here if I can find my go-to. There it is, go-to, and the next one was on the May the 6th, so 06 05, and there we go, May the 6th. So what happened there? Trading range 50 pips. It had a bit more of a movement. What happened with the news? Let's just move this out of the way here. So basically, earnings dropped slightly to what was expected. The change was better, and the expected 3.5 became 3.6. Again, a bit of a mixed bag there. It's slightly negative. What happened? Well, the euro dropped. This is looking at the euro dollar. The euro dropped against it, and as we ran through the hours, it dropped against it. What was it doing in trend? It was a mess beforehand. What did it do afterwards? Looking at the dailies here, where have we got the 6th of the 5th, 6th of May, that's the one. What did it do? It was chopping. Where were the opportunities? They weren't really too much. Now, scalping, maybe you got a few pips out of it, but at 50 pip overall move, there might have been some opportunity, but I probably should have looked at it on a 30-minute chart, and I can switch it. But either way, when you're looking at it on the dailies, there was very little drift. What was the main trend doing? Selling. Was the news positive? It was okay, and the euro carried on weakening a few days later, but either way, not a great deal of difference. Okay, come back to the pivot. Next one. In fact, let's just make it a 30-minute chart so you can see a little bit easier, and go to get the go-to. The next one was the 3rd of June 03 06. There you go, 130 candle, so you can see it clearly. This is what happened. It sold. Let's just bring that up out of the way. So the earnings again didn't come in with the estimate. They were low estimate, which is deflationary rather than inflationary. Employment change was 390, so it's better than expected. And again, the estimate rate was 3.6 versus 3.5. They were consistent in their expectations here, if nothing else. Anyway, what did it do to the market on that candle? We did see quite a movement, 36 pips in overall. Next bar, what did it do? It was an inside bar. It wasn't given any guidance, particularly one way or the other. What did it do in the bigger scheme of things? Let's just go back and just check the date of this. It's the 3rd of the 6th. And where were we? The 3rd of the 6th. That was up here somewhere. 3rd of the 6th. Really didn't do anything. There was no great change. It was the technicals came out sometime later and continued the sort of major trend to the downside there. Just going to move this across, and let's go back to the pivots here. Pivot bar, say the pivots, but go to the next one, which was the 8th of July. So 08 07, so a bit later that month, and 08 07, where's the bar? There's the 130 bar, 45 pip movement. Did it get? I mean, on each of these occasions, you could say, "Well, I'll just sell a euro each time." It's very risky in itself. It'll probably be the time that it goes the other way. But the euro did see softening here. It came out pretty much in line 370. The jobs were a lot better in terms of the job change, hence the move to the downside for the euro. But look what happened. It just come back up to where it was, and we see this a lot with news, is where the price comes back up to the news, the trend it was in prior to the news. And this was pretty strongish trend in terms of change. Okay, the average earnings hadn't increased, so it's not particularly inflationary at that time. Daily wise, well, didn't really make too much difference. The market just continued rolling over afterwards. So next day after the Monday, and I said, wait for the Monday, see what happens. Well, it happened. It happened on the Monday. Right. Okay, and finally go to the 5th of August. That's 0508 here. Now this is quite a. I've got the headline numbers here. Earnings 0.5. They were up against the expectation of, he says, because I hadn't written it there, 0.3. So really inflationary earnings seen there. The change was significantly bigger than expected. The change in employment came out there at 528 versus 250 extra jobs, and of course the unemployment rate, well, that's pretty much finally got down to 3.5 versus 3.6 expected. So changed overall. Big old bar, there we go, got the 130 bar, big old bar. It was 78 pip bar. If you could have caught that, great. What happened afterwards? There was a bit of a continuation. If you were trading, looking for anything in it, it didn't go too far afterwards, and it came right the way back. If you drew a regression line across it probably came back to the regression. What did it look like on the dailies? Well, there it is. It actually went up a few days later before it finally ran off. So in summary, it's a very risky trade to be in. Look for it afterwards. Look for when the technicals show you the plan, as opposed to trying to get in there and guess what's going to happen. Hope you find this useful. If you would like to come and join me, you can actually join. I've got some free days in the my live trading room in the mornings. I say days, they're just morning sessions I do. It's a planning session that we do for day trading, swing trading, position trading. We look at the lot, look at what the markets are doing, top-down analysis, good old-fashioned analysis. If you want to come and join me, you'll see a link, or two options, one option for two options to come in terms of when they're happening. But there we go. I hope you find this useful. If you do, give me a thumbs up. Please subscribe to my channel if you're not already a member. Take care. Bye for now.